Hey, Colorado, Chris Lopez here, and we have a great guest today who's going to talk about the lazy 1031 exchange. So, as you know, you may be one of these investors that ask us, we've talked to, and they say, hey, I've got all this equity in my Denver or my Colorado Springs rental property. What can I do with it to maximize it? Now, it used to be a lot of 1031 trade ups or refi and buys. Well, the market has shifted. That's a lot tougher. So that means other opportunities appear. And so we're going to talk about some advanced ways to do that, plus some alternative asset classes you can 1031 into as you get out of your rental properties. And I'm joined by my co-host, Jenny Bayless. Hey, Jenny.
Hey, Chris.
I am very excited for this podcast, and thank you for teeing it up. Our guest is Thomas Castelli, who is a real estate investor and a CPA, so a fantastic combination. And he's also the host of the Tax Smart Real Estate Investing podcast. Welcome to the show, Thomas.
Thank you for having me. It's a pleasure to be here with you both today.
Yeah, we're really excited. And, a couple months ago, I know Jenny attended one of your podcasts, or not podcasts, your webinars called the Lazy 1031 Exchange. Jenny, can you fill us in on that and then why we had to have Thomas on the show?
Yeah, I love this because I actually inadvertently did it last year for 2022, but I think that it's a fantastic option for people that perhaps want to take some chips off of the table and don't want to be up against a time crunch that a 1031 puts them into. And as we know, that can kind of create some bad decision-making process when the clock is ticking. So I just love that the options that the lazy 1031 provides people is just another alternative for them to think through as they make their decisions.
So, Thomas, what is the lazy 1031? How do we even start attacking this question?
Okay, great. I mean, so that's a great question. So the lazy 1031 exchange is a name for a strategy that has actually been around since the 80s, but has, thanks to bonus depreciation, which I'm sure we'll dive into a little bit deeper, has really gained a lot of traction and a lot of popularity over the last few years since the tail end of 2017. So I guess the best way to break it down is to start with a quick overview of the passive activity rules. And because that plays a big role. So that's kind of the foundation of this strategy. So I'll give the quick overview. So back in before 1986, you were able just to buy a rental property. And these rental properties would typically generate losses thanks to a non-cash expense called depreciation, which only really exists on paper. So in other words, what that could allow you to do is that can allow you to have a property that you're generating positive cash flow from, but yet you're telling the IRS and the state tax authorities that you're losing money. And that's thanks to this depreciation expense. So then the Tax Reform Act of 1986 came about. And what that did is introduce something called Section 469 of the tax code, the passive activity rules, which made losses from rental activities passive by default. And what that meant is that you can no longer take, before this, you could just take these losses and use it to offset your W-2 or perhaps your active business income, really no questions asked. But what the passive activity rules did is say all rental activities are passive by default. And that means that these losses can no longer offset your active income. They can only offset other passive income, which for many investors is their rental income or gains on the sale of their rental properties. So there's something called REPS, the real estate professional status, that was later introduced that could allow people who work full-time in real estate to offset their active income. But if you're not working full-time in real estate, that's not really relevant. So the question really becomes, how can you best maximize these passive losses? So what ends up happening is when you buy that rental property, if you do something called a cost segregation study, what that will do for you. So let me back up real quick and break it down like this. So when you buy a property, it's not just the house. It's not just the walls. You have all these various components within that property. Things like light fixtures, appliances. You might have land improvements like landscaping, pools, sheds, things of that nature. And when you buy that property, everything is lumped into one bucket. It's usually 27 and a half years for residential property. So that means that your property is effectively depreciated 127.5. So just a little bit every year. And while that can help shelter a lot of your rental income from tax, it's not going to usually produce sizable losses for you. But now, thanks to the Tax Cuts and Jobs Act of 2017, we now have something called bonus depreciation, which allows you to significantly accelerate depreciation on property with a class life of less than 20 years. So what a cost segregation study allows you to do is it basically someone comes down to your property, or sometimes software can do it for you, and it's going to give you a report of the various components of your property. So for residential real estate, you're going to have 27 and a half years. You're going to have 15-year property. You might have a little bit of 7-year property or and then 5-year property. And depending, it's all property dependent, market dependent, depending on where you are, but usually somewhere between 20 to 30% of your property's value can be reallocated into this 5, 7, and 15-year bucket and bonus depreciated. Now, here where we are in 2024, bonus depreciation is 60%. So I'll give you an example of what that'll look like. Now in 2023, it was 80%. So let's just say, for example, you bought a $500,000 property, and let's just say that, so land is never depreciated. So something I should mention there. So we always have to allocate a land value to your property. Now that will be determined usually based on the property tax card or an independent third-party appraisal. But for the sake of this example, we'll assume that 80% is allocated to the actual building itself.
That's actually a pretty common example we see around here in Denver and Springs. I mean, I was actually looking at a rental property day with a client, and her property was 79%. So 80% is perfect for our audience here.
Yeah, no, it's a very common it's a very common number, and sometimes it'll align. So if we go with the 80%, that means you have $400,000 in the building value, and let's just take right down the middle that 25% of that is going to be eligible for bonus depreciation. So that's going to give you, on that $400,000 property, that's going to give you $100,000 as bonus depreciation eligible. Now we're going to go ahead and we're going to take 60% of that, excuse me, we're in 2024. So that's going to give you a depreciation deduction in that first year of $60,000. Now, not to get too technical with a little bit of other stuff, but basically there's going to be other the remaining 40% will start depreciating that you didn't take in bonus depreciation, and the other, and 27 and a half year, 0.5 year will still start to depreciate. So it's really going to come out to be around somewhere around 68.5K, but that's going to be the amount of basically depreciation you're getting that first year. And that's usually going to cause a sizable loss on your property. So you might actually make money, and that's awesome. But you're going to tell the IRS you have this big loss. Now, the question is, what happens to this big loss? Well, the passive activity rules state that it's first going to offset any passive income that you might have for the year. So if you have passive rental income, positive rental income that might be being thrown off of other properties, it's going to help you offset that passive income, so you're not paying tax on your rental income. Now, if you did sell any properties, it can help offset the gain. We'll get more into that in a second. That is the lazy 1031 exchange. But if you're not using it, if you're not using these passive losses, you don't have enough passive income, these losses don't just disappear. They get suspended and carried forward to your next year's tax return. And oftentimes what happens is, if you're in this situation where you're not able to use these passive losses every year, they start to accumulate.
Can I jump in here to help? Like, because you are like, Jen and I are following you, and this is, knowledge we've learned a long time, and I've talked to a lot of clients about this. I want to like pause here to make sure people don't get lost, because we get this bonus depreciation, and let's just say it's at $60,000 to keep it simple. Now, if I'm a rep status, or I'm a real estate professional status, but Jenny is not, I can use all the depreciation across any income, correct?
Right. If you have the real estate professional status, if you spend more than 750 hours and more than half of your total working time working in real estate, you can take those losses, the $60,000 in losses, use it to offset your W-2, your active business, or your other non-passive income. And you would be able to use that in that case.
Yeah.
But then in this... Oh, go ahead, Jenny.
I was just going to jump in and say, most of the people listening to this podcast, there are exceptions. They have a day job, so they are not rep status. So just kind of wanted to highlight that. So if you have a day job, pay a special attention, because this is a really cool trick that you'll be able to utilize.
Yeah. And so it's where, like, it's not like if you don't use it, you lose it. That's not the case. but that's where it depends. Hey, depending on how you're categorized, you may be able to use it all in 1 year. But if not, this tees up into what you were saying, where it'll start carrying forward. And I have this conversation a lot, so I want people to follow along because, like, we see too many people leaving money on the table for to Uncle Sam.
Yeah, right, absolutely. So if you're not able to use it, it's going to carry forward. And the good thing about that is that it can help you shelter future rental income from taxes. The first thing it does for you, which is phenomenal. But the second thing, and often what we've seen over the last few years be really powerful, is what's become known as the lazy 1031 exchange. So to preface the 1031, so usually when you do a 1031 exchange, you have to go to a qualified intermediary. They have to receive the funds at the closing table. Then you have a 45-day window to identify typically 3 properties or up to 3 properties that you might acquire. And you have a total of 180 days, just about 6 months or so, to actually acquire the next property. And that allows you to defer your capital gain down the line. But those timelines are pretty tight, right? It's pretty tough to do that. So where the lazy 1031 exchange comes in is it allows you to sell your property, and then you can use the suspended passive losses that you had previously, if you had any, to start offsetting that capital gain on sale. If you don't have enough suspended passive losses, and these can be found just, by the way, on Form 8582 of your tax return. That's where you could find your suspended passive losses. Now, if you don't have enough, what you can do is you can go and invest into another property in that same year. So this is the key to this strategy. It has to be in the same taxable year. So for in 2024, you're looking at if you sell property within 2024, you need to acquire this property anywhere between 1/1/24 and 1 to 12/31/2024. So same taxable year. Then you can go do the cost segregation study on that new property, use the depreciation, the losses that are generated on this new property to offset the gains on the property you just sold. And if you buy a large enough property and you have enough losses that are able to offset the gain, you don't pay taxes on the gain and you don't need to use a 1031 exchange. Now, buying a rental property is one way to do that. It's one way to generate these losses. There are other ways we could dive into, other ways to generate losses.
I want to talk about those, but before we talk about that, I do want to talk about some like strategy because Jenny said she inadvertently did this, and we have clients doing this. So like, I think a way to really maximize the trends, especially here in Colorado, is we're very seasonal. Is the best time to sell a property is the springtime. We're going to get the most buyers in the door and get top dollar for your property. So like if someone were to do this in the springtime, like list your property in February, March, or April, no tenant in there, sell it to an owner occupant. And then the best time to buy a property is usually fall or late winter when there's the least amount of demand. So if an investor really wants to go out there and, sell the highest possible highest possible price and buy at the lowest possible price, that's one of the ways I would attack it. And Jenny, I'm curious if you have any thoughts on there or if that's actually what you did.
So I accidentally did it because I wasn't planning on purchasing a subsequent property. So I sold one property. I had about, we'll say, 100 and change in gain and recapture. And then I ended up finding a multifamily that I really liked and purchased that and did a cost seg on it. So they identified about 150K in the cost seg study. So that essentially wiped out my gain from the prior sale. So I liked it because I did not feel like I was on the clock. I don't like to make fast choices. Anyone who knows me knows that it takes me forever to think through anything. So, just feeling rushed that, oh my gosh, I'm going to have to pay taxes on this gain, like that would just lead me to make a poor decision in my opinion. That's just kind of how I am. So I liked that option of just kind of being able to be done with property A, paid, I essentially, paid the gains or whatever through, or I guess they went into that bucket. And then when I did the cost seg, it wiped it out. So I didn't actually have to write a check at the end of the year. So that's, I think, a pretty phenomenal strategy. And then, on top of that, I think that it's also interesting if you could essentially do a reverse lazy 1031 as long as it's in that same calendar year. So, I know a lot of people want to do reverse 1031s, and we end up telling them it's like going to be very, very complicated. Just the logistics of a reverse 1031 is not fun. So if you are able to take down that property before selling your other property, you have all year to do it if you want to start in January. So.
And Tom, before we go into some of these alternatives to 1031s, I know we already have people thinking, hey, is Thomas or is Thomas's firm taking on new clients for CPAs? One of the hardest referrals we have are CPAs that know real estate, and then CPAs that know real estate and who are taking on clients. So
Right.
can you tell us like a little bit about your practice and what type of clients you are or not taking on? Because I know we have a lot of investors out there asking that question.
Yeah, absolutely, and appreciate the question. So we're Hall CPA. We're a firm that's across the United States. We have a lot of clients in Colorado, and what we do is we basically work exclusively with real estate investors. Some of our clients have as little as one property, and our biggest clients are funds of hundreds and hundreds of properties. So we kind of see everything across the gamut, if you will. We work with long-term and short-term rental investors. And primarily what we do is we take a little bit of a different approach than a lot of other CPA firms do. So one of the biggest complaints we have from our clients is that our prior CPA never told us any of this. Never told us how to use the lazy 1031 exchange, or never told us how to do anything to reduce taxes. So we take a very proactive approach with our clients, and many of our clients start with tax advisory, where we're sitting down with them, we're learning about their tax and financial situation, their goals for the future, and giving them a roadmap, or a blueprint rather, of the strategies that are available to them to reduce their taxes. So that's the first way that we work with clients. Of course, we do tax preparation, so filing tax returns, and we have clients who outsource their accounting, their bookkeeping to us as well. As for are we taking on clients, we are always taking on clients. So we're a growing CPA firm, and we have a phenomenal recruiting system, a recruiting pipeline to continue adding to our team. We have a lot of accountants who want to work for our firm, so we are always taking on clients. Having said that, though, we do have a cutoff for 2023 tax preparation, and that usually comes somewhere around March-ish, where we'll stop taking on clients for 2023, and we're then working with them on 2024 and beyond. So that's a little bit in a nutshell how we work.
That's awesome. Thank you. All right, let's get into these alternative 1031 strategies, because we talked about this briefly before we got in the podcast. And when interest rates were low, man, it was always no brainer. Just 1031, sell the house, buy the fourplex, right? That was the common example we saw and keep trading up. Now with high interest rates and flattening rents, it makes it tougher to 1031 to a 40 or 50% down payment type situation. So what are some alternatives people can do outside like buying another rental property?
Right, that's a great question. So the best part about this strategy is that there's other businesses that generate passive losses. So if you're not actively involved in the business, it's typically going to be passive for you. And specifically here, what I'm talking about is partnerships, like limited partnership interests for the most part. So for example, you can go and invest in a syndicate, real estate syndicate, a multifamily or commercial. And while this is still in the rental realm or in the real estate realm, you don't necessarily have to do the work. There's usually professional property management, professional sponsors who do this day to day operating the property, and they'll usually do cost segregation studies and then pass the losses back to their investors. So one alternative, rather than buying the property yourself, is going and investing in a syndicate or fund who's going to pass the losses back to you. So that's one option. Then there's other asset classes you could look at. One of them is ATM machines, very popular for this exact purpose, for the lazy 1031 exchange. And that's because ATM machines are 5-year property. So when you invest in an ATM machine fund, they're all your entire investment is pretty much eligible for bonus depreciation. Let me clarify. When I say your entire investment, what I mean is all of the property that you're buying, pretty much the ATM machines are eligible. So you can get substantial losses passed back from ATM fund machine investments. Same thing.
Is that why I've seen so many ATM funds? Okay, that I didn't realize. So just the way, because they're 5-year, since they're 5-year life cycles or 5-year vehicles, you can basically depreciate all that in year one. Is that what you're saying?
Right.
Bonus depreciation.
Yeah. Or with bonus depreciation. Yeah. Okay.
Yeah.
That makes a lot more sense.
Yeah, so there could be quite sizable losses from ATM machines, and they usually pay you. Usually with ATM machines, it's a cash flow play. So you're making cash flow while you're getting these large losses in the first few years. Now, with the next one is car washes, self storage. These are all asset classes that typically generate large losses for you thanks to the depreciation. So those are just some alternatives. Another one is well, we'll maybe get to that in a second. I was going to say mineral rights, but you have to 1031 exchange into them. But those are the ones, if you wanted to use the lazy 1031 exchange method, you go into invest into these other businesses or real estate as a limited partner, and they'll be able to generate sizable losses for you.
Yeah. So you're to make sure I'm understanding this correctly, you're saying, hey, the same principle, the lazy 1031, sell a property, don't do a 1031, and then invest in another asset, front load a lot of the depreciation through cost segregation, whether it's a rental, multifamily syndication, or an ATM fund, do a lazy 1031 in that manner across any of those assets, right?
Yeah, absolutely, absolutely. I'll just throw one thing out there. With a good thing about ATM machines, you don't have to do the cost seg with an ATM machine because it's already identified as 5-year property. But
Oh.
principle applies basically.
Okay, that's really cool. Thank you. All right, I do want to talk about mineral rights though, because I've heard
Can
people
I
do
butt
it.
in with one more lazy 1031
Of
question?
course.
So, Thomas, I know the other alternative is if you've been an investor for, probably many years, and you've had that day job the whole time. You've never been able to be considered reps. So everyone, I guess, that maybe falls into that bucket, they should, you mentioned the form 8582. They should really go check out that line item, that suspended passive losses, to see if they even need to purchase a subsequent asset, right? To wipe out their gains.
Oh yeah, that's a fantastic point. That's such an essential Form 8582, because you might already have a substantial amount of passive losses. You might even have enough passive losses to offset the gain on the property you already sold, and you might not even know it.
Mm-hmm.
So before you run out and say, "Oh, I need to go grab a new property," and you might want to do that for investment purposes, but if you're just doing it for the tax or primarily for tax, go look at that Form 8582 first. It'll be on your prior year tax return. So chances are, when you're listening to this, probably going to be your 2022 tax return, I have to imagine. And you go pull up that form, see how many passive losses you still have left. And if it's enough to offset your estimated gain on sale, you might not need to do anything at all and still be able to use the lazy 1031 exchange.
Perfect.
Correct. All right, mineral rights. I am so curious about this. Out of everything we've talked about, this is what I know the least amount. And I've had a couple clients do 1031s and mineral rights, and I've just been completely fascinated by it. So explain away, please.
Yeah, absolutely. So we've actually dove deep into this relatively recently with a gentleman named Troy. But basically, the way it works is when you're doing mineral rights, you're 1031 exchanging into pretty much the land or to the property, and then you're basically selling off the mineral rights or licensing out the mineral rights, for lack of a better word for it, where then you're receiving a royalty. So basically the way it works is you have your property that you might have been managing. You execute the 1031 exchange. You now have this other property that's basically someone else coming and drilling on that property, right? Someone else taking the mineral rights, drilling, say like Exxon, for example, and then just paying you a royalty. So it's a way to generate a substantial amount of income with basically doing little work, because once you 1031 exchange in that property, that mineral rights is going to pay you out sometimes for decades. So it's another alternative that if you can identify, especially if you can identify the property first, even before you're about to sell, it can make it really easy for you to not have to go through the headache of that 1031 exchange timeline, or make it a lot easier for you.
So for these investments, it sounds like it's a very high cash on cash return, essentially, by buying and selling mineral rights. Are you getting depreciation, debt pay down, or appreciation typically, or is it mostly just cash flow?
Yeah, so typically with the mineral rights, you're getting a lot of the cash flow from it. The benefit of it, you're getting depletion, which is it's basically like depreciation, but for the minerals themselves, right? Every time you mine the minerals, you're depleting the mineral source, and you get basically 15%. 15%. Right, exactly how it works off the top of my head. But you're basically getting like a 15% deduction from the income that you're generating thanks to depletion. But the real power of this comes from being able to defer your capital gain into this from your property using the 1031 exchange into this basically this asset class that you have to do virtually no work on, and you're just getting a stream of cash flow. So a lot of people will use this towards the end when they're ready to like retire. Essentially, they'll say, you know what can I do? Should I use a DST? Should I do something else, or can I go into mineral rights? So mineral rights is a great cash flow play for somebody who's ready to pretty much retire.
Can
How
you
does that?
give? Oh, go ahead, Jenny.
Oh, sorry. I was just going to ask, how does that work? So if you have, a piece of land that depletes, on that schedule that you mentioned. So let's say at the end of, 8 years or whatever, it's essentially worthless because all the minerals are gone. What what are typically the next plays at that point? Because now you just own like just regular land, right? Or I guess land with holes all over it. I didn't know what the next stage would be for that case.
Yeah. That's a great question. That's a great question. And to tell you the truth, I don't have a great answer for it. What
Okay.
you really do at that place, what you would want to do with most of these cash flow plays is you recoup your investment through the cash flow. So
Hmm.
like basically when at the end, like for example, the ATM machine is very similar. At the end of the ATM machine fund, like when you're done with the term of your investment, there's no salvage value. There's no residual value. It's zero, but you recouped a substantial return on your investment through the cash flow. So I've not gotten that far yet into the mineral rights to say what happens when it's done. But
Okay.
what I would say is that you're going to generate your return on investment through the cash flow. So by the time you get to the end, that the residual value in the property is not of major concern if you invested in the right if you invest in the right opportunity.
So if you're 1031ing from something into that, and then it's essentially useless at the end, you could essentially just leave it be, right? And then you don't have any tax implications, assuming you're going to stay alive for the next,
Yeah,
however many years.
yeah, yeah. That's a great question, and
Okay.
I gotta be upfront. I don't have a great answer.
Sure,
I
sure.
don't have a great answer for that.
Okay. One last question on here, and this might be out of what you know from these deals. I'm curious, like for mineral rights, like what type of cash on cash return do people see? I'm trying to put in like real estate terms. I get, hey, a majority of my investment back will be through cash flow, but do you know is like a 10%, 20%, or is that outside of your purview?
Yeah, so from what I've seen, it's upwards of 20%. So you might be getting like a
Wow.
28%. That's why these plays. That's what makes these plays work. Is that you're getting such a high cash on cash return that the residual value of the property at the end is not of major consequence. It's not. It's like you've already made your money through the cash flow.
I think I'll
This
be
is
going
out
down some Google
Googling.
rabbits hole next couple of weeks. This is awesome. Thank you. All right, let's go about DSTs here because this is a very common question we get from real estate investors, either selling and doing 1031 straight away, or sometimes they kind of keep a DST in the back pocket for like, hey, my 1031 failed, I'll roll into a DST. So first off, like, can you explain what a DST is, the process of it? Then I've got a couple questions I want to pick your brain on about it.
Yeah, absolutely. So when you have a 1031 exchange, you have to exchange real property for real property. So it has to be another piece of real estate. And that means that if you wanted to 1031 exchange into a syndicate, it's usually not possible. There's a lot of workarounds that are costly from a legal perspective to do. But basically what the DST does is the DST is what the IRS blessed this vehicle, this Delaware Statutory Trust, as a 1031 exchange alternative. So you can take not alternative, but a vehicle that you can 1031 exchange into. So usually the DST is run by a professional manager or sponsors, they might call it. And they're buying properties like institutional grade properties for the most part, things like Walgreens, or they might buy a Best Buy or a Dollar General, things of that nature, or industrial properties in some cases. And what you're doing is you're 1031 exchanging into the DST, and now you own a fraction or a portion of this larger property that's operated by a professional property manager and professional asset managers, so that you're hands off at that point. So you've taken your asset that you owned and controlled, you 1031 exchanged into this larger asset that you have a fractional ownership in that you no longer control, but you no longer have to manage it. So that's the DST in a nutshell.
So with DSTs, I don't know if you have an opinion on here, but like I've never been like I love the idea of like, hey, I can 1031 into it, right? Hey, that sounds really good for me. I defer taxes now. But where I've not been super excited about DSTs is the returns have been, on the lower side. And I
Right.
also feel like there's usually heavy fees. Um, can you comment on just kind of like the return profile or fee profile if you've seen enough of these deals yourself?
Yeah, the returns are pretty low, usually in the single digits, and the fees can be quite high. And that's one of the major downsides of the DST is it's not it the sponsors to put these things together, they do take a fee out of it, and then on top of that, the returns are lower because you're buying these high grade like Class A institutional grade assets that don't have a major return. It's just very similar to a syndicate or fund. With a syndicate or fund, you're usually making a lot of money through a value add strategy, where you're buying a property that might have deferred maintenance or might need to be repositioned. You're putting a substantial amount of capital into it, pushing the asset up, its value up, and then selling it, right? So you're making a lot of the money typically in these deals off of the appreciation. However, with the DST, you're buying the Class A property, so there's not much value to be added in the first place. And then you have is usually a triple net lease, so the cash flow is not very substantial comparatively to other asset classes that you might be able to
Yeah.
invest in, and that's what most people go to DSTs because they don't want to manage property anymore, and they want the safety. They want the safety of a Class A, like institutional grade asset that they know they'll get their smaller yield on, their smaller cash flow, but they're more comfortable that their wealth is safe. Like the
Mhm.
the equity that they accumulated over the years is safe.
Yeah, the few clients I've had who've done DSTs, they've been more on like the older retiree side where they're not so much in growth mode, but like asset preservation, more just income mode. Is that generally what you've seen with your clients?
Yeah, no, absolutely.
Okay.
That's pretty much the exact profile for the DST. If you're in growth mode, most people in growth mode don't want to give up control of their assets to like a sponsor, for example, and then they don't, and also they want to continue the equity accumulation play. So this is really the DST is the most appropriate once you've already accumulated your wealth, and now you're looking to kind of just step back from the day to day, and you want to almost preserve your wealth.
Okay. Great. That's very helpful.
Mhm.
What about 721 exchanges? I feel like, at least for me, like I don't know, 18 months ago, 2 years ago, I started seeing a lot of 721 exchange offerings. Can you tell us what those are and tell us how they play into this role of potential 1031 like options?
Yeah, absolutely. So the 721 exchange allows you to contribute a property to a partnership. And when you contribute your property to the partnership, you will receive a partnership interest in exchange for your contribution of your property. And usually what you're doing is when the 1030 with the 721, you're contributing into a partnership that owns a lot of other properties. So what happens is you contribute your property, you get your partnership interest. Now you're basically invested in a pool of other investments, and this contribution is tax free. So it's you're deferring it. It's similar to a 1031 exchange, not quite the same, but similar. And then like as you start selling off your partnership interests that you acquired, that's when you start paying the capital gains tax that you would have paid had you sold your property. So that's kind of the 1031 exchange in a nutshell. Again, just to summarize that, you're contributing your property to a partnership, you're deferring the capital gains tax, you're getting a partnership interest, and presumably in most cases the partnership you're investing into has a lot of properties, so you're diversifying. um, Now these are also known as upreit transactions. So depending on the entity that or the investment company or investment vehicle that you go with, it you could invest in like high grade institutional grade assets, or some companies have been doing this on a smaller scale, recently, and you've been able to basically get into a pool of diversified assets. For example, this one fund that I know, they'll accept single family properties into their 721. They'll accept office buildings. They'll accept multifamily properties. They'll accept a diverse array of assets into their fund, which makes it easy for you to go ahead and contribute to it while also diversifying. Now, if the way these have traditionally worked in the past is that you'd have to typically 1031 exchange into a larger asset. So, for example, most of these funds wouldn't accept a single family house, but they might accept a Class A office building. So you might 1031 exchange into a Class A office building, perhaps through a DST. That's not uncommon, and then later on, that is contributed into the fund, and they're accepting this larger office building. So depending on the opportunity you could find out there, you might be able to contribute your property directly to the 721, directly to the partnership right off the bat if they'll accept it. Or sometimes you might have to go through a 1031 exchange, and then that asset would be then later 721 exchanged into the partnership.
I love all the workarounds that investors and professionals come up with so we can minimize the tax burden. And yeah, that's been one of the things that I got enamored for a bit with 721 exchange. Like, wow, this looks like an amazing way to go out there and, and kind of like, have your cake and eat it too. But a couple of the ones I saw that did accept like single family rentals directly, they often had such like a small buy box criteria. A lot of times like properties like I had or clients that it wouldn't fit the buy box. And I've seen a lot, from my perspective, a lot better opportunities with like, hey, sell your property on your own and then 1031 into like a bigger asset where they a lot of times like will have, hey, we have this open for a couple of months. Anyone wants to hop in here, go into here, and then we'll roll it over or whatever the proper term is into the UPREIT. I'm curious from the deals you've seen. Have you seen, it sounds like you've seen a lot more go towards like the bigger asset then be absorbed versus like the single family being directly absorbed by the 721?
Yeah. So that's tradition. That's like for the most part, like 90% of what we see. There is this one fund that I'm aware of. Actually, I told them about the 721 exchange like 2 years later. They come back, they open up a fund that now accepts other properties, and they'll accept like single families. They'll accept smaller properties, and then they'll either sell the properties or they'll put debt on the properties. They have different strategies they use to monetize those properties within their portfolio. But I think as this information becomes more and more accessible, like typically to find out about a 721 exchange, you'd have to go to an attorney or a really experienced accountant. They'd have to tell you how to do it. And then for you to actually pull it off, you'd usually be a pretty sizable fund or perhaps even a REIT. But now as like this information becomes more and more democratized, I guess you could say, or widespread, you're seeing other funds starting to utilize this strategy in different ways than we've previously seen it done.
Great explanation. So Thomas, we went through mineral rights, DSTs, 721 exchanges on top of options for the lazy 1031 of selling and buying a rental and cost saving, selling and buying a fund with heavy depreciation. Any other strategies that you want to leave our listeners before we wrap up for this episode?
Yeah, I think we covered a lot here today. I mean, there's so much that I could go into. I would say if you're going to be selling your properties, you definitely want to explore these various options. The sooner that you realize you're going to sell your property or you're contemplating selling your property, the sooner you can explore these strategies, the more flexibility and more options you're likely to have. So I would probably just leave it. I'd probably just leave it there. I would say one that's let's just leave it there. I don't want to go. Let's just leave it there for today.
All right. Well, you're leaving the door open for a part 2 episode. I love it because I know we'll get a lot of questions from here, and like the devil's in the details. And to highlight on one thing that Thomas said about like, hey, the sooner you start discussing it, the better. Don't be like, hey, I sold my property. Can I do a 1031? No, Jen and I have gotten calls like that. I'm sure Thomas has as well. And no, if it's sold, you're out of luck for additional 1031. But you can do a lazy 1031. But man, the second you start thinking I might sell a property, start analyzing your opportunity cost for other investments out there. But also, most importantly, sit down and talk with your tax strategist, or if you need one, talk to Thomas and his company, and see what your options are on there. And as a friendly disclaimer reminder, we are not giving financial, accounting, or legal advice on here. We are just giving you some ideas and strategies. Make sure you talk with your professional team, or if you need referrals, we're happy to refer you out to them. But we're just sharing education for everyone to go out there and hopefully percolate ideas to go out there and make more money and pay less taxes going forward. So, Thomas, thank you so much. And then what is the best way people can find your podcast and also find out about your accounting firm?
Yeah, absolutely. So you could find the podcast is on basically all podcast platforms: Apple, Google, Spotify. The Tax Smart REI podcast. You could just search it; you'll find it. And then if you want to learn more about our firm, it would be therealestatecpa.com/Thomas. That's my personal page over there. And from there, you can learn more about how we work. And if you want to request a consultation, we'd love to learn more about your situation, how we can help.
Awesome. Well, Thomas, thank you so much. We appreciate your time and your expertise. And Jenny, as always, amazing job on teeing up a great guest. Another fun show to co-host with you. So thank you.
Thanks, Chris. Thanks, Thomas, for coming on. We really appreciate it.
Thanks for having me. It's been a pleasure.
All right, everyone. If you need any help analyzing your options, come talk to us. This is stuff we do ourselves day in, day out. We're investors ourselves. We also love talking shop. Thanks a lot, everyone.